Wells Fargo shares dive after Fed replaces 4 board members. Restricts banks' growth citing consumer abuses. The Federal Reserve said Friday it is restricting Wells Fargo's size in response to widespread consumer abuses. As a result, Wells Fargo plans to replace 3 directors by April and a 4th by the end of the year. The Fed is prohibiting the bank from growing any larger than its total assets as of the end of 2017 until sufficient improvements are made. Shares of the bank briefly fell 6% in after-hours trading. We cannot tolerate pervasive and persistent misconduct at any bank, and the consumers harmed by Wells Fargo expect that robust and comprehensive reforms will be put in place to make certain that the abuses do not occur again, Fed Chair Janet Yellen said in a statement. The enforcement action we are taking today will ensure that Wells Fargo will not expand until it is able to do so safely and with the protections needed to manage all of its risks and protect its customers, she said. Yellen completes her term at the Fed this week and begins at the Brookings Institution Monday. The Fed did not note any new abuses by the bank in its statement, and neither release mentioned specific names of board members who would be removed. Wells Fargo said in a release that within 60 days it will provide details to the Fed about a plan for enhancing the board's governance oversight and the company's compliance and operational risk management. We take this order seriously and are focused on addressing all of the Federal Reserve's concerns, Wells Fargo President and CEO Timothy Sloan said in a separate statement. He noted the order is unrelated to the bank's financial condition, which remains strong. Sloan took over as CEO in the fall of 2016 as the bank has tried to recover from a consumer sales scandal. One of those changes was an August announcement for a board shakeup. It was discovered in 2016 that Wells Fargo workers had opened about 2 million consumer deposit and credit card accounts without customers' authorization since 2011. The bank paid $185 million in penalties. In 2017, the bank also reached a preliminary class action settlement of $142 million over concerns about retail sales practices and unauthorized accounts from 2002. Fed slams Wells Fargo with penalty. As 4 board members ousted, the Federal Reserve took action against Wells Fargo for the first time in connection with the massive fake accounts scandal and other customer abuses that have been uncovered at the giant bank since 2016. In an unprecedented enforcement action announced Friday evening, just as Janet Yellen closed out her final day as Fed chair, the central bank will prevent the San Francisco-based lender from growing any larger than it was at the end of 2017 until it improves its governance and risk management. Wells Fargo will also replace 3 current board members by April and a 4th board member by the end of the year. The members were not named. Senator Elizabeth Warren, D-Mass, one of the harshest critics of the bank's handling of the scandal, has repeatedly called on Yellen to remove the bank's board ever since the account scandal exploded. These events have caused substantial consumer harm and have troubled the Board of Governors, the Fed said in a letter to the Wells board. It called on the directors to make sure that senior management has sufficient resources and is commensurate with the firm's size, complexity, and risk profile. Fed officials said the agency did not directly order the bank to remove board members, which is within its power under certain circumstances. But the enforcement action requires Wells to improve the effectiveness of its board. We take this order seriously and are focused on addressing all of the Federal Reserve's concerns, Wells Fargo CEO Tim Sloan said in a statement. It is important to note that the consent order is not related to any new matters, but to prior issues where we have already made significant progress. The board vote was 3-0. The fourth board member, Fed regulatory czar Randall Quarles, is recused from matters concerning Wells Fargo because his in-laws have long-standing ties to the bank. The San Francisco Fed and the staff member in charge of the Fed Board's supervisory division, Michael Gibson, will determine when the bank has met the terms of the order. Fed officials said the order was announced Friday evening because the bank only consented to it on Friday afternoon. Still, it was striking that the vote came on the day that Yellen wound up her career at the central bank. While this is the first time the Fed has penalized the bank, other regulators have already weighed in. In September 2016, the Consumer Financial Protection Bureau and the Office of the Comptroller of the Currency, as well as the Los Angeles City Attorney's Office, fined Wells Fargo $185 million for opening potentially millions of fake accounts. Since then, the bank has revealed that the scope of the scandal was larger than originally thought and that it had charged hundreds of thousands of customers for auto insurance they didn't need. Another group of victims, military veterans. The wide-ranging nature of the problems at Wells Fargo have been attributed, in part, to its decentralized structure and a lack of awareness by the board of what was going on in the bank. The firm's lack of effective oversight and control of compliance and operational risks contributed in material ways to the substantial harm suffered by WFC's customers, the Fed said. Specifically, the board of directors must take steps to improve reporting from senior management. Wells had already named 3 new people to its 13-member board. 3 more, including Chairman Steve Sanger, retired at the end of the year, when Betsy Duke, a former Fed governor, took over as chair. The CEO at the time, John Stumpf, also stepped down shortly after widely panned testimony before Congress on the scandal. Wells' board decided to claw back a combined $69 million in compensation from Stumpf, as well as $66.3 million in stock options and unvested equity awards from former community banking head Carrie Tolstead. The Fed, as part of its multiple actions Friday, also sent letters to each Stumpf and Sanger to let them know their actions did not live up to the central bank's expectations.